Hey everyone, and welcome to today's Explainer. If you follow ad tech, AI infrastructure, or marketing software even a little bit, Zeta Global has absolutely been on your radar. I mean, heading into their August 4th, 2026 earnings report, they were riding this legendary 20-quarter streak of beating Wall Street's expectations. 20 consecutive quarters. That kind of consistency is just almost unheard of in this space, and everybody was watching closely to see if they could actually make it 21. And, well, true to form, they delivered the beat. But that brings us to the central financial mystery we're unpacking today. How on earth does a company deliver a massive Q2 earnings beat, yet still watch its stock suddenly tumble by 8%? You have to ask yourself, was this actually a bad quarter disguised as a good one, or is the market just being wildly unforgiving right now? Okay, let's dive into this. We're looking at the ultimate paradox for investors. On one side, you've got this flawless 20-quarter winning streak of totally over-delivering. And on the other, a sudden, jarring 8% drop literally the moment their latest numbers came out. So today, we're going to unpack the verified numbers, analyze the underlying strategy, and figure out exactly why Wall Street seemingly threw a tantrum despite the company posting record revenue.
Part 1. The Top-Line Triumph.
To solve this puzzle, we have to start right at the top of the income statement. Revenue for the second quarter of 2026 came in at a massive $443 million. Now, let's be real, this isn't just a slight bump. It represents a staggering 44% year-over-year increase. For any company operating at this kind of scale, growing your top line by nearly half in a single year, that is a massive achievement. Just to put that into perspective, Wall Street analysts had set the bar at $420.6 million. Zeta cleared that easily, beating estimates by nearly $23 million. That is a significant, undeniable top-line beat that officially cemented their 21st consecutive quarter of blowing past revenue expectations. And they aren't just buying this growth either. Profitability soared right alongside that revenue. Their adjusted EBITDA hit $92 million, which is a massive 56% increase from the previous year. That translates to a 20.7% EBITDA margin. And if you know SaaS, maintaining a margin over 20% for a software company scaling this incredibly fast is the absolute dream scenario. So top line is crushing it, and operational cash flow is up 56%. Everything looks great, right? Part 2, the EPS miss explained. Now what's really interesting about this slide is it brings us straight to the reality check. Because if the top line and the operational cash flow were both so fantastic, why the sudden stock crash? Well, we have to pivot to the bottom line. Here is the reality. 3 cents. Zeta reported a GAAP earnings per share, which is your strict accounting profit, of just 3 cents. When you contrast that microscopic little number with the massive $443 million top-line revenue, you start to see where the friction is coming from. See, institutional investors, the big whales who actually move the market, they were expecting an EPS of almost 20 cents, specifically 19.95 cents. So Zeta missed that expectation by nearly 17 cents. Now, to be entirely fair, the company did report a positive net income of $8.17 million. They are profitable. But when whales pay a premium for a growth stock, they demand to see the bottom line earnings expanding just as fast as the revenue. When they saw a 17-cent miss, they didn't hesitate. They hit the sell button. But let's resolve this disconnect, because if we take it step by step, we can see exactly what's happening under the hood here. Step 1, obviously, is that massive revenue growth we just verified. Step 2 is the actual root cause of the EPS miss. They are heavily investing in enterprise sales and vital AI infrastructure. And step 3 is the resulting short-term EPS hit. Basically, Zeta is intentionally trading short-term accounting profitability so they can aggressively capture long-term market share. It's the classic tech playbook, right? Spend money now to build an impenetrable moat later. Part 3, the strategic AI pivot. To really get why they're spending so heavily, you have to look at the core of their pivot. Management has made it abundantly clear they are evolving away from being just a simple marketing platform and transforming into a highly intelligent AI infrastructure platform. First off, they're driving rapid adoption of their proprietary Athena AI assistant to predict consumer behavior. But the real game changers? Those are their strategic collaborations with OpenAI and Palantir. By integrating massive proprietary datasets directly with large language models, Zeta is carving out a huge edge over their fragmented legacy competitors. And this brilliantly illustrates exactly what the CEO is going for. He explained that because of these new AI tools, they are no longer just selling a single point solution to Fortune 500 companies. No, they are pitching a central brain for the marketing department.
That is a fundamental shift in how they position their value to the absolute biggest enterprises in the world. Part 4. A billion-dollar war chest. Because let's face it, building that central AI brain requires serious capital. Zeta just announced they've secured a massive $1 billion credit facility, and management has a very explicit plan for this firepower. With interest rates sitting where they are, they intend to use this capital for share buybacks and, crucially, to consolidate the market. They are actively hunting for smaller competitors who possess complementary AI or data capabilities that they can just plug directly into their new system.
And here is exactly why that war chest matters so much. Yes, they had a Q2 EPS miss, but right alongside that miss, they actually raised their full year 2026 revenue guidance to between $1.811 billion and $1.824 billion. Raising guidance while you are actively spending heavily is a massively bullish signal. It's essentially telling the market, hey, our sales pipeline is incredibly strong, our AI products are gaining real traction, and we have very high visibility into our growth for the rest of the year.
Part 5. Bulls, Bears, and the Verdict. Let's move to and see how this builds our understanding of the stock's actual valuation.
Right now, Wall Street is entirely split on how to value this company. As it stands, Zeta is trading at a price-to-sales ratio of 4.2x. Now, when you compare that to other high-growth AI and SaaS competitors who are routinely trading at multiples of 8x or even 10x, it reveals something pretty stark. The market is currently valuing Zeta much more like a mature, stable company rather than the hypergrowth tech disruptor its 44% growth rate implies it is. So we essentially have two very distinct camps here. The bulls look at this and see a massive buying opportunity. They're pointing straight to the 44% revenue growth, the EBITDA expansion, those game-changing AI partnerships with Palantir and OpenAI, and of course that $1 billion credit line ready to consolidate the market. The bears, however, are totally focused on structural risks. They're worried about looming data privacy regulations eventually catching up to ad tech. They point out high client concentration risks if a major customer decides to leave. And they're really questioning if this whole AI narrative is just hype masking a core business that is actually maturing. Which leaves us with this final, pivotal question. Is trading short-term profitability for long-term AI market share worth the risk? For the long-term believers, this earnings dip might just be noise in the face of a brilliant strategic pivot. But the short-term volatility, that's very real. Just keep in mind, Zeta has a long history of providing conservative guidance and then absolutely blowing it out of the water. I highly encourage you to pull up their SEC 8K filings and verify these numbers for yourself to see exactly which side of the debate you land on. Thank you so much for joining me on this explainer, and I'll see you in the next one.